Hello guys, welcome to the second video where we are reading chapter 2 from It's About to Happen. Let's get started. Chapter 2, Drawing Lines. So much of trading and technical analysis looks easy on the internet, for example. So you can find all sorts of trading systems showing how trades were initiated at point A and sold at point B for a 3000% profit in only 4 months. A book on technical analysis might glorify buying breakouts or the breaking of trend line. Trends do require breakouts in order to persist, but unfortunately, the penetration of a trend line per se guarantees little. What preceded the trend line break and the way it occurred reveals more. Then we have the skeptics who fall back to the old saying lines are drawn to the broken. So what? Price movement evolves and we redraw. Drawing support and resistance lines might seem the subject of charting 101. Some say it's for beginners, but you would be surprised by how many people cannot tailor the placement of their lines to highlight the behavior in a trading range. However, even fewer have learned to recognize horizontal lines around which prices have revolved. Let's first look at a typical trading range and imagine we are examining figure 2.1. Figure 2.1 level 3 communications from the viewpoint of the rightmost day, December 26, 2003. December 2003. Okay. We see a great deal of lateral movement. A great After the September 25 high, right? After the September 5 high, September 25 high, a resistance line is drawn across this high, and the initial low on October 2 serves as the support line. So what we have here is our resistance line, our support. Yeah, support line, our resistance on from this then now what it's saying is a resistance line is drawn across this high, and the initial low on October 2 serves as the support line. Yep. Why did I choose these 2 points for resistance support levels, you might ask? The high and the low on October 15 and 24. 15 October 20, 15 and 24. 24 could have worked equally well, right? This and this could have worked equally well, maybe even better, as the top occurred on 15 in real time, right? This in 15 in real time, I might have framed the trading range with the October high low. Okay, but looking in retrospect from right to left, the two bold lines tell a better story. They dramatize the failures in October and November to move upward or lower. At, at, two, at two of these points, the sellers attempted to take control of the stock and drive prices lower. Okay, what is saying is at these 2 points, right, this and this, first sellers attempted to draw the price lower, and at this point, 2nd October, the buyers attempted to take the market higher. Okay, all right. So now Each time, however, the buyers checked the decline and prices recovered. Okay, buyer did check the decline right here, and the buyers checked the decline and prices did recover to a new high, right? And now what we have is this is this is important information. It tells us buyers remain dominant. The support line brings the struggle between the buyers and sellers into focus. Okay. During the latter half of December, in the latter half of December, notice notice the lifting of supports as the buyers gradually overcame the selling pressure. We do see the lifting of support here. The November one, this is the December one. Lifting of, this supports as the buyers gradually overcame this, such as such a sustained rise in price with most of the closes near the daily high tells a more bullish story than white flaying action, indicates the stock is in a strong trend. Okay, so yeah, we do see the complete story by drawing support and resistance. Now let's move to the next paragraph. The resistance line, the resistance line drawn across September 25th here, September 25th. High was penetrated on October 14. October 14, it did penetrated here, right? Penetrated this resistance line where prices registered their highest close. Their highest close. At this point, the buyers were seemingly in control. On the following day, however, the sellers turned back and back the advance and drove prices back down in the trading range. And then the next day, sellers came in and they drove the prices down and closed below. And it, closes below that trading range. This is our trading range. Our trading area between support and resistance. Draw a rectangle. Our trading. Yep. So we see that it did closes below trading range, right? This reversal action threatened upward from the August low. Okay? August low, right? This one, until prices refused to break down on October 24th. This one, it did went down, right, and tested this trading range, testing this trading range, right? It's October trading range. Okay, right. So this reversal action threatened the uptrend from the August low until prices, right, until prices refused to break down on October 24th. Okay, here, and November 17th. We retested this trading range. If we extend this trading range, we did retested this trading range. See, we touched down here and then bounced back, tested here and then bounced back. Okay, so notice the October high here has not played any role during this trading range. A line of resistance did from across the November 4th, yep, high, as it blocked the two rallies in December, right? As it blocked the two rallies in December. In December, it blocked two rallies here, here, and here, right? It marked the high of a trading range that began from the October 24th low. Okay, so this one, October 24th low, it marked the high of a trading range that began from the October 24th. So there is new trading range forming here. We can see here. Okay, and then what we right, it marked the high of a trading range that began from October 24th. It is not uncommon to see trading ranges within larger ranges, especially when they span several months. Okay, so basically saying that we see trading ranges within larger trading ranges, right? Let's move paragraph. See, the trading range in LVLT spanned about 20% of the October peak price. We have to consider it if it of intermediate size. On hourly charts, we find many small trading ranges that swing less than 1% from high to low. This may last only a few days at most, while the support or resistance lines may not always tell as vivid a story about failed opportunities as we saw in LVLT. They do so the case of a downtrend, the steady progression of lower lows and lower highs, right? As demonstrated on the Agnico Eagle Mines hourly figure 2.2, here this one, the lines reveal how prices interact with previously drawn lines. Okay? These lines reveals how prices interact with previously drawn lines. Okay, trading range AA dash dominates the chart. It contains a smaller, this trading range, the larger trading range, right, which dominates the chart, and it contains a smaller ranges like B and C. So what we are doing is have this trading range, we have this larger trading range, right, and then we have this smaller trading range. Okay, now saying, so contains a smaller range BC which fails to support the market, right? So it basically, this range failed to support the market and it went down, right, forming a new trading range. Okay, but the breakdown to support line D leads to one last rally into the larger trading range, right? This one, this rally, larger trading range. This rally ends with an upward spike on January 17th. Upward spike on January 17th. This one, 2012, right? The weak close on this price reveal the presence of selling. So the weak close, this one is the weak close on this price bar reveal the presence of selling. Support line D also serves as an axis line as prices repeatedly try to recover from below it. Okay, so this support line D also serves as axis as price did try to repeatedly try to recover from it. Okay, recovered from below it, right, below it. The last of these occurred on the up move from support line E, right? Okay, the last of these occurred on the up move from support line E. By drawing these lines, the trader can anticipate price swings to peak or bottom around previous support or resistance lines. They become an important part of a trader's arsenal, especially when combined with trend lines, channels, price volume behavior. Okay, we are laying the background here on what we are observing in the market is basically by drawing these lines, the trader can anticipate price swings to peak or bottom. So, you know, after drawing these support lines, what we are observing is price tend to, come to these areas, test it, and recovers from it or go below it, above it. Basically the market tend to follow this, you know these structures. Okay, we have this trading range, bigger trading range here, then we have this trading range here. Okay, so saying that after by drawing these lines, the trader can anticipate price swings to peak or bottom around previous support resistance, right? So we can basically, you know after drawing this, we can say that, you know we form peak here, we form bottom here, we draw this support, this range, right? And the market will, revisit this area of support and resistance. As we can see here, it visited this area after rally. Well, first traded within the range, then it went down, and then it went up, testing this resistance area, and then it again formed this new support line at C, and then it formed new resistance line on the peak at B. So it goes on like this. Okay, and we see that, and we see trading ranges within trading ranges, right? So they become an important part of a trader's arsenal, especially when combined with trend lines, channels, and price volume behavior. Okay, now some of the most useful axis lines appear on daily charts. On the March 2006 bond daily chart, figure 2.3, resistance line A, drawn across the latter 2005 high, 2005 high. Okay, so we are doing this. We are drawing this line. Now, provided support line in on the March 2006 bond daily chart, figure 2.3, resistance line A, right, drawn across the late November 2005 high, here. Provided support line in January 2006. So in 2006 provided this support line in January 2006, and resistance twice in February 2006, right? And this resistance in this work, there is resistance 2006 February. The two rallies in February were tests of the breakdown below line A. The two rallies in February were these two rallies in February, okay, were tests of the breakdown below line A. Okay, so this was the test of a breakdown below line A. This works, it's working as a resistance here, right? The axis line alone does not reveal strength or weakness, nor does it signal to buy or sell. It simply shows a level that has repeatedly served as support and resistance. Prices may have revolved around it, for several weeks or months. Many times the final rally in a top formation or the final downswing in a bottom will occur along an axis line. Okay, what makes this line most meaningful is the price volume behavior around it. But one first must learn to see the lines. With practice, you will be able to see all of the linear relationships at a glance. Okay, now let's move to the next paragraph. When we draw these horizontal lines, we repeatedly see the false moves on either side of a trading range. Compare the false breakout on October 15th in LVLT figure 2.1, figure 2.1, October 15th. Here, false breakout here, right? One. With the January spike in March bonds. Okay, this this is the bond. So January spike would be this one, right? And yep, all of this behavior stands out with the aid of the lines. Notice the small trading range in LVLT during July August 2003, July August, July July August. Yep, this trading range. And it, like the sell off on November 17th, like the sell off on November 17, right? It tested this area of this range, right? That's what it's saying. Now it, like the sell off on November 17, led to a bullish turnaround after a false breakdown, right? This one, bullish turnaround after a false breakdown. This one, turnaround after a false breakdown. It recalled here, remounted here. So what we are seeing here is which led to a bullish turnaround after false breakout. Trading ranges are horizontal patterns. They are resolved in three ways: a long drawn out period of lateral movement that tries out the most die-hard longs by the formation of an apex in which the amplitude of the price swings narrows to a point of equilibrium, or a false breakout or breakdown. In the chapters ahead, we will explain much more of this behavior. Trend lines depict the angle of advance or decline. They are dynamic support and resistance lines as opposed to the static horizontal lines that frame trading ranges. In a downtrend, a trend line is drawn across successively long lower highs. Okay, so in a downtrend, a trend line is drawn across successively lower highs. So basically, we know the the how you define a trend is if you like an uptrend is formed when we see higher highs and higher lows. A downtrend is formed when we see lower lows and lower highs. So it's basically saying this that concept. Okay, so we see in a downtrend, a trend line is drawn across successively lower highs. It seems uncanny that a trend line can be drawn across highs. For example, in January and March, which later provides resistance in July and September. The resistance points in July and September are known as touch points. Okay, so we gotta do this July and September, right? Resistance line in July and September provides us touch points, right? These touch points for this to test. See, the market did test did touch this trading ranges. Okay, see here. So which later provides resistance in July and September. Okay, the resistance points in July and September are known as touch points, that is places within a trend where rallies halted, means the rallies have been halted, stop there against the trend line, right? Touch points. Okay, all right. touch points touch points add validity. Touch points add validity to a trend line. In an uptrend, a trend line is drawn across the rising supports. It is called the demand line as it marks the point where buying repeatedly emerges. Similarly, the downtrend line across high is called the supply line. As we will discuss, as will be discussed, these are combined to create trend channels. Let's begin with some samples of uptrend lines. Normally they are drawn from the low point of a decline. Okay, so generally these are drawn from a low point of a decline. Okay, so what we are doing here is we see this low point of a decline, we draw a line from it. Combining this low point of decline, we draw this line. Forget that this happened, right? Forget that this happened. Okay, and you can basically you know see this one, right? And then this is demand line. Okay, this demand line where buying occurred. Where buying occurred. Okay, so we have our trend line. Now so we begin with some we are beginning with some sample examples of uptrend lines. Normally it is drawn from the low point of a decline, right? We do not want to draw a trend line through price movement. Okay, so it's basically saying we don't want to do this, right? In the middle of price movement. Okay, so there's that. uh, the demand line. Okay, we do not want to draw a trend line through price movement to reach the second anchor point. On the daily continuation chart of the 10-year treasury note figure 2.4, we see the simplest uptrend line. The lows of November 4 and December 5th serve as the anchor points. This line provided support on 3 additional corrections, although, right, this line provided support on 3 additional corrections like 1, 2 and 3. We see this, right? It's providing support there. Okay, so although price broke slightly below the line at point 3, it quickly recovered to make a new high. You can immediately see the inherent risks in automatically going short slowly on the penetration of an uptrend line. As previously stated, the behavior prior to the trend line break and the way it occurs tell the story. After you finish reading this book, the bearish behavior prior to the January 25th breakdown will be apparent, right? So this is what is saying, this one. After reading this book, will, the bearish behavior of the prior to the January 25th this year will be apparent. Okay? 2 months later, the 10-year fell below 10,524. Okay. Now, trend lines are drawn from the perspective of the last day on the chart. One looks across the chart like a surveyor taking out land for development. Okay, a second daily LT chart, figure 2.5, is shown through December 1 to 2005. Looking backward, we fit a minor trend line onto the rally from the October low. Okay, October low. Okay, we do not use the precise low as the first anchor point. This one. Okay, if we did, the line would not fit the angle of advance. Instead, we draw the line from the low of the fourth day, point 1. If I step upward, if I steep uptrend line A is drawn from this low, it will pass through price movement, right? This one from point A, and it will pass through price movement. So we don't want to do that. So we seek next point, right? The low at point 2 is a better second anchor, for the line is free and clear of other prices, and it later provides support at point 3, right? So what we do is we draw a line from A, an angle line from point A to point 2, going as far as we can, right? Now, so it later provides support at line at point 3, right? One more factor at point 2, we do not know prices will continue upward. Connecting points 1 and 2 creates a tentative line until, right, again, 1, right? So it creates a tentative line until the high at B exceeded, right? Okay. Okay. A rally above B. So connecting point 1 and 2 creates a tentative line until the high at B is exceeded. Okay. Okay. A rally above B constitutes, so it's basically saying that this high at B is exceeded here at from point 3, right? So connecting point 1 and 2 creates a tentative line until the high at B is exceeded, right? A rally above B constitutes an uptrend. Okay, so rally above B will constitute as an uptrend. Okay, this, we did see this channel, right? We draw like this. Okay, so this will construct as a uptrend. Okay, uptrend. Now a rally above B constitutes an uptrend. I'm not so terribly rigid, for the line can always be redrawn later. If one applied the same reasoning to the 10-year chart, figure 2.4, the uptrend line would not be confirmed until the rally in late December. This rally exceeded the November high, this one. Okay, because the December touch points at 1 and 2 holds along the line, right? I would not hesitate to draw it. Okay, yeah, would not hesitate to draw it. So if LVLT figure 2.5 had immediately rallied above 58.95, this one, if LVLT figure 2.5 had immediately rallied above 58.95 after December 1, the trend line should here would no longer depict the angle of advance. Yeah. Okay. A new line drawn from point 1 would not capture the angle of advance. So right, if this goes above this point, right, one, suppose like this, right, then this won't cover that, this won't be a valid line, or yep, depict the angle of advance. A new line drawn from point 1, a new line drawn from point 1 would not capture the angle of advance. This also occurs after lengthy periods of lateral movement within a larger uptrend. The monthly chart figure 2.6, here we are moving to next point. Okay. The monthly chart figure 2.6, this chart here, let's draw a rectangle that would this chart. Okay, the monthly chart figure 2.6 of the DAW from the March 2003 low provides a good example. Here we have an uptrend line drawn across 2003 and 2004 lows. Okay, so this low 2003 and this 2004 lows, we have an uptrend line drawn here, right? This one. See, the line not necessarily be perfect line. Okay, let's again. Okay, so but the correction from the March 2005 high penetrates this line. March 2005 correction penetrates this line right here and goes below, and 6 months of lateral movement follow, right, and then the 6 months of this lateral movement follows. Okay, let's draw it. This lateral, okay. When the trend resumes, we could redraw the trend line of the 2003 and October 2005 lows. Okay, but it would be too shallow. A better choice involves drawing a second parallel line and anchoring it off the 2005 low. Okay, so it's basically this one, right? This maintains the original angle of advance, but it did not do a good job of pinpointing the October 2007 high, right? So what it's basically saying is, if we have one angle of advance right here, we do have one angle of advance, so the best thing would be to redraw it as same angle of advance touching this low of 2005, so that we capture the same angle of advance. Okay, all right. Now, reference to parallel lines brings us to the subject of trend channels. In an up channel, the demand line is drawn across lows and a parallel supply line is drawn across an intervening high. Figure 2.7 describes the anchor points and the order in which they are connected. Right, so this one, point 1 point drawn like this, channel line. Then in the same angle of advance, we draw the trend channel as connecting the high and with same angle of advances. Okay, you can quickly see this pattern by drawing a line across the high of point B on the LVLT chart, figure 2.5. Let's go and see figure 2.5 then. At B, so we draw this line with same angle of advance here, point A 1 and this P. See this, we do see that, we do see that market testing this area of, supply, right, area of this supply, and eventually going down. Okay, this ideal up channel will have several additional touch points. It should capture most of the price work within its boundaries. A rally above the top of an up channel, often a better overbought indication that most mathematical tools yet. A rally above the top of an up channel is often a better overbought indication than most mathematical tools like RSI. If you know about RSI doesn't work like all the time, right? It doesn't have that depiction. So here we do see that, after combining this, we do see this market has been overbought at this point, and we can say that, market will advance downwards, right? And it did happen. So this depicts the overbought condition. Rather than relying on RSI, we see this, we can apply this in any chart, right? And it works better than most mathematical. Okay, so a more interesting set of channels appears on the daily chart of April 2006, live cattle 2008, figure 2.8. Okay, so this is figure 2.8. Let me put it up. We're looking at this here now. This chart, cattle chart. Now, okay. So here we have low points at 1 and 2. Here we have low points at 1 and 2. In the early stages of the advance, right? In the earliest stages of advance, we have 1.1 and 0.2, right, which is low points, and we draw an line with these two anchor points. Okay, and we look for drawing a parallel channel at the high of this. Okay, so the parallel is not drawn across an intervening high. Instead, it is drawn across the early October high at 90 cents, right? This October high at 90 cents. Okay, so draw this line here, parallel channel, and if the line had been drawn across the intervening high in late September, this September high, right, it would have, involved in this price movement, right? Okay, the supply line would have passed through almost all of the price war. We have to be free and creative with the placement of our lines. At the same time, we cannot force the placement You can readily see the trading range at the top of the chart. Okay, see that there are trading ranges here. It's testing this point, touch points here, a lot of touch points, acting as a dynamic support and resistance line within this trading channel, this within this trend line channels. Okay, you can readily see the trading range at the top of the chart. Yes, we can see that it consists of a false breakout above the high and a wide open break that penetrated the bottom of the range, right? We do see that this false breakout, right? This false breakout occurring at many points in this line, and high and a wide open break that penetrated, and this wide open break which penetrated the bottom of the range, right? This one. Okay, these were some of the clues that prices were turning down. Yep, prices were definitely turning down, and I cannot omit the steep down channel to the April 2006 one, this channel low, right? April 2006 low. Okay, you can see the three anchor points and the anemic rally in mid-March. Notice how prices made upward progresses above the minor supply line during this small lateral movement. This one, right? This one. In April, prices plunged to the demand line. This is demand line. In April, okay, so this is demand line, demand line. Right? You see the three anchor points and the anemic rally in mid-March. Notice how prices made upward progress above the minor supply. This one, above this minor supply line during this small lateral movement, right? April, prices plunged to the demand line and reversed upward. Okay, so prices plunged up to this demand line, and it went upward. Okay, was upward. This is the largest rally within the down move. I hope you see the license taken within the anchor points used in this down channel. Perhaps in real time I would have begun differently, but once the contract broke below 90 cents, the best channel would have become apparent. Okay, this one, 90 cents, right below this, which indicates that best channel would have become apparent to us. Okay, paragraph. Something else has to be mentioned regarding upturns. Bob Evans, one of the most prominent and enthusiastic teachers of the Wyckoff course, used to prepare cassette tapes on which he discussed aspects of chart trading. He devised colorful metaphors for describing different kinds of market behavior. In one of his most famous tapes, he shared with his listeners a learning tool devised by a former student. It was called the Cell Driver's Tragedy, and dealt with the behavior after breakdown below the demand line of an up channel. He compared the market's rise within the channel to a diver who picks cells off the ocean floor and returns to the surface, which is supply line. Okay, so it's basically saying the metaphor. Suppose this is the ocean floor, right, and this is the ocean top surface. So by applying the metaphor, suppose the shell is here, we are picking shellfish here, shells here, and we are going to the surface of the ocean, right? Which is our supply line. So this is our supply line, and this is our demand line. Okay, now bring it back for reference, where he places them in a floating basket. Okay, so where he places them in a floating basket, and if floating basket did fell down, so let's just extend the metaphor and think metaphorically with some intuition, that if you have basket of cell in ocean floor, it might go down and go down to a ocean floor again, right? And it might, and when we pick it up, the same ocean cells, we put it on basket, floating basket up there in ocean, right? So this kind of metaphoric patterns happening again and again in an upward channel or downward channel, right, depending on how you look at, how you interpret the ocean, right? In this case we are talking of ocean in the upward channel movement. Okay, now let's move to the next point, where, okay, yeah, at some point during this activity he falls below his usual depth, his demand line. Okay, so this one, we're talking about this one, this demand line, it falls below this demand line and develops a cramp. He tries valiantly to reach the surface but falls short and rolls over for the final time, right? Okay, this is what it's describing. So yeah, he tries valiantly to reach the surface, he tries valiantly to reach the surface but falls short and rolls over for the final time, rolls over time. On the cattle chart, point 1 marks the final attempt to reach the top of the up channel. From this tale, we learn to watch the character of the rally following the break of the demand line. This demand line, this supply line. If prices recover, and surge to new highs, the odds favor a resumption of the uptrend. Right? If price recover and surge to new high of this, the odds favor a resumption of an uptrend, but it didn't happen, right? If it, instead of this, it went like this, it would have resumption of uptrend. Okay, and we would have drawn a new channel, new uptrend channel. On the monthly chart of the Commonly Research Bureau CRB index figures 2.9, we are on to chart again. Okay, now see the non-inflationary rise from the 2001 low. See this 2001 low. This steep advance fits beautifully within the up channel originally drawn from points 1, 2, 3. Okay, notice the numerous touch points at later dates. Okay, so what we do is we draw a channel with these points 1, 2 and 3, combining these 3 points, and then parallel to this angle of advance, draw, okay, point 3. So now, after the low in January 2005, when energy prices began to rise exponentially, the advance steepened and prices traded along the supply line. Okay, this is our demand line, this is our supply line. So prices surged back up, traded around supply line. A second parallel line is drawn from the high at point 4. So draw a second parallel line from 4, and it stops the next two up moves. Okay, and it stops the next two up moves here, as illustrated on the monthly Dow chart, figure 2.6. Okay, a second parallel line broadens a channel and provides a useful guide for viewing price movement. In the case of CRB's index, the lines do not indicate the uptrend has ended. It is steepened and continued for several more years. Okay. Yep. It did. It was. Did indeed it was an uptrend. Okay. One more type of line deserves attention. It is the reverse trend line and reverse trend channel. The basic look is sketched in figure 2.10. So we are moving on figure 2.10. Let's see. We are looking here. Okay. Figure 2.10. All right. So they are normally drawn with dashed line, reverse trend line, dashed line, to set them apart from normal trend lines and channels, right? Some uptrends will not fit in the normal channels we have previously discussed. Okay, because of their steepness, they require drawing a reverse trend line across rising highs, points 1 and 2, right? To make a reverse up channel, a parallel line is drawn across an intervening low. In the diagram 2.10, price does not interact with the lower line of the up channel. However, in the future, it could provide support. Many times, a normal uptrend line will combine nicely with a reverse trend line to form converging lines. Some technicians refer to this as a rising wedge. In the instance of an uptrend, the converging lines often indicate a rally is trailing or losing momentum. When prices are falling within a pattern of converging lines, it usually signifies the decline in nearing low. So if the prices are falling within the pattern of converging lines, okay, so basically saying this, okay, we have this line, and then we have this line, and they are converging, like it's this, 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 right? Then it usually signifies the decline in nearing a low. Okay, meaning we might see a breakout after this move. Okay, so what we have here is what's happening. Okay. In figure 2.11 figure, so this is our reverse trend channel. Try this thing here. Okay, so um, right. Okay, so this is our reverse up channel, reverse down channel, converging lines. This is converging line. So what it basically means is, in order to draw reverse up channel, we need 3 points, two highs, one low. Okay. For drawing reverse down channel, we need two lows, one high, and for drawing converging lines, we need two highs and two lows. Okay. Figure 2.11. Let's draw a rectangle here. Okay. Figure 2.11 reverse channel examples presents an unnamed chart with the three types of reverse trend lines channels mentioned above. Okay. Reverse trend lines channels mentioned above here, right? It's basically indicating these three lines, right? So we have this first for channel. Okay. First, let's talk about downward channel. For downward channel to draw, need 3 points, right? If you want to draw three channels, like can this one, draw line there. Okay, let's see what mentioned. The decline on the left side of the chart fits into a reverse down channel. It is drawn by connecting the two lows, and then the parallel is attached to the intervening high. These two lows as then this intervening high. Okay. The reverse up channel CC dash is much steeper and price moves above line C. Okay, notice the sell off from this high found support on parallel line C dash. Okay, so if we draw then reverse up channel here from here to there, right? Connecting this high to this high, because we need two high and one low. We got one low and this is too high. Okay, which is much steeper and price moves above the line C, right? This price moves above this line C, right? Notice the sell off from this high found support on parallel line C dash. Sell off from this line found a support on this parallel line C dash. A move above or below a reverse trend line often will mark the end of a swing. But this is very important, which is saying a move above or below a reverse trend line often will mark the end of swing. Okay, all right. So this the move is happening above here. The move above this trend line will mark the end of the swing high, and the sell off is happening here, and it's finding the support here. Well, when it's reaching here, move from this support line is marking the end of swing low, and it's going up, right? Okay, so I know an ingenious trader who has developed software showing how many stocks per day have reached or exceeded reverse trend lines. In an uptrend, a large increase in the number of these often indicates the market is vulnerable to a downturn. Lines B, B prime do not form a reverse channel, right? Line B and B prime. This B, line B, and this line B prime do not form a reverse channel. Line B is a reverse trend line chat. Line B is a reverse trend line that, when combined with normal trend line B prime, forms the converging or wedge pattern. Okay. 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 So I have never considered chart patterns of any significance except for this one, as it is most associated with ending action. I cannot stress enough how often a move above or below a reverse trend line channel will lead to a trend reversal. Okay, so cannot stress enough how often a move above or below a reverse trend line or channel will lead to a trend reversal. The Standard and Poor's S&P daily continuation chart 2000 figure 2.12 shows the price movement after the August 2011 low. Okay, this one. So the volatile trading range shows the price movement after the August 2011 low. The volatile trading range AB was resolved by a thrust to new lows and an upward reversal. Notice this reversal occurred after the break below the reverse trend line within the declining wedge. So saying this one, we have this channel here over here. This channel, right? And then we have this reverse channel, reverse wedge one. This, then this, right? And market, this went down and tested this support line A, channel A, channel AB on support line A. The reversal happened here. Okay, so notice this reversal occurred after the break below the reverse trend line. Break below this reverse trend line within the declining wedge. Circles are drawn around the overshoot. This is the overshoot at the October 4th low and the October 27 high. Okay, So we have again this line for 4th to 27th. This one, the latter was about the reverse trend channel and resulted in this one channel. Now saying this, the latter was about the reverse trend channel and resulted in 142 point sell off. This one, line B served as both resistance and support during the months shown here. This line was the launch pad for a large up move from the December low. Okay, this one. This B, line B served as resistance here, right, and then as acted as support here, right, here, and here. And we have this rally. Okay. The live cattle quarterly chart. Now we are moving to next chart. The live cattle quarterly chart figure 2.13 shows a reverse trend channel spanning many years. Looking backward from the 2011 high, one can detect the reverse trend channel, the reverse trend line A, drawn across 1993 to 2003 high. Okay. Right now, the vertical price rise. Now, from this that concept, we draw this channel, finding two high and one low for upward channel. The vertical price rise in 2011 pushed prices above this line. The parallel A prime to this reverse trend line is drawn across the 1996 low here. In this situation, the line passes through some of the price movement, but it was a parallel rather than a starting line. Okay, you see how frequently the market respected the parallel line, right? See, this one respected the parallel line very frequently. Okay, yet it could not have been drawn until after the 2003 high. Okay, normal up channel is drawn across the 2002 and 2003 lows, 2009 lows. This one, right, this one 2003 and 2009 up channel and lows. A normal up channel is drawn across the 2002 to 2009 lows. B with a parallel across the 2003 high, B prime 9, this channel. Price rallied to the very top of this channel where we have a confluence of lines. Okay, together they underscore the magnitude of the potential extremity, right? The stock market reached a major high in October 2007 and most issues declined accordingly. One exception was US Steel, figure 2.14, which consolidated throughout 2007. It erupted in April 2008 and gained almost $70 per share in the next 2 months. This one, till 2007, was basically consolidated, right? Then it erupted on April 2008, gained $70 per share. Okay, so price this here and then erupted from there and set on 70. Okay, per share. Okay, the next 2 months. All right. So up move exceeded the confines of any normal up channel. After the stock rallied above the reverse trend line here in June 2008, the bullish trend finally came to an end and prices collapsed. As you can see, exceeding up and down, reverse trend lines must put one on alert for a trend reversal. Okay, no other trend line break has such predictive value. Yep. Now, some some price trends defy channels. Here, advance or decline is too steep to fit into a normal or broadened channel. The uptrend on the weekly July 2006 sugar chart, figure 2.15, between May 2005 and February 2006. Suppressed trends defy channels. Their advance or decline is too fit into a normal or broadened channel. The uptrend on the weekly July 2006 sugar chart, this one, between May 2005 and February 2006, typifies the problem. Take a look at the 5 points labeled on the weekly chart. Only lines I can conceive begin with points 3 and 5, right? A parallel line across point 4 fails. Okay, fails to hold as prices soar beyond its boundary. One draws a second parallel line across point 2. The broadened channel does contain most of the price movement until the final high. Okay, this may not be a totally legal way to draw a channel because the high of the second parallel occurred prior to points 3, 5. Okay, because this high occurred prior to point 3 and 5, so it's not a a legal way to draw, or basically a right way to draw channel, but it works. Drawing support or resistance lines, trend lines and channels, normal, reverse or broaden, demands open-mindedness. One must always consider other possibilities. Enough mechanics, now we are ready for the story of the lines, right? So guys, this is the end of chapter 2. We studied drawing channels, drawing reverse channels, drawing parallel channels, drawing support and resistance lines, right? Drawing, basically identifying trading ranges. So that's the wrap of chapter 2, and tomorrow we're gonna be reading, understanding chapter 3, the story of the lines. For now, thank you. I'll see you in